It was. So with a fixed rate, you're paying more from the beginning, but you're assuming it'll even out over the course of it or whatever. It's still predictable. But
Yeah, the
with
longer you hold
floating, yeah, but with floating, that's usually more appealing on the front end, and then you have no clue what's going to happen on the back end. So, welcome to the Ironclad Underwriting Podcast, where precision meets performance in commercial real estate. I'm your host, Jason Williams, and every week we deep dive into the strategies and systems and stories behind rock solid underwriting. Whether you're a seasoned analyst, an up-and-coming investor, or a commercial real estate professional looking to sharpen your edge, this show is your front row seat to expert insights, emerging trends, and real-world underwriting tactics that stand the test of time and scrutiny. From market assumptions to debt structuring, cap rates to cash flow, we're cutting through the noise and getting to the numbers that matter. So sharpen your pencils and fire up those models. Let's get to work. This is Ironclad Underwriting. Hey, everybody. Welcome to this episode of the Ironclad Underwriting Podcast. I'm your host, Jason Williams, and I got my good friend, business partner, and co-host, Frank Patalano, with me here today. How are you doing, Frank?
good, sir. Ready to talk about money again.
Yep. We're continuing on our series on financing and how to get debt and what the debt terms mean and everything else related to debt. So, our first, episode of the series, we featured special guest Julianne Peterson, and then the last episode we went into different loan types. And today, let's deep dive into interest rates, the risks associated with them, rate caps, what they are, what they're for, how to use them, everything interest related. Ready to jump in?
Definitely.
Okay, so I guess one of the first things people want to know about, or they might have heard about it, but maybe not understand completely, is what's the difference in a fixed and a floating interest rate? So, what is your take on it?
I mean, fixed is usually one number for the whole length of the term. Um, when you say floating, I also use the word variable sometimes. I'm not sure if that's different or if that's the same. And I mean, I have heard floating before. I've also there's some deals that I'm in where it might be a 20-year loan, but every 5 years it resets. So it's not really fixed. It's
Yeah.
like, go
So,
ahead.
so and what killed the housing market in 2008 were the floating rates. Back then, a lot of times they called them ARMs, adjustable rate mortgages. They're still considered ARMs, but I haven't really seen that term used since 2008 because I think they got a bad rep. But yeah, a floating rate could be changes. It could be a monthly change. Could be a change every 3 years, every 5 years. But generally, when I think of floating, I think of it's varying every month.
Yeah.
And that's usually based off of like some index or whatever. And when Julianne Peterson was on, she talked a little bit about the SOFR, SOFR, which is, I think it's the secured overnight financing rate, something like that. And what this is you might have like a SOFR at 5, and then the bank will be like 2.5 spread over that, so that your rate for that month would be like 7.5. Then if the SOFR drops the next month to like 4.5, your rate would then be 7. 4.5 plus 2.5. So the spread is pretty much going to be the same throughout, and then it's a SOFR or it could be a treasury or whatever that's going to fluctuate, and that's what's going to cause the floating part. Before
So when I look
fixed,
up SOFR rate today, it says 3.7. And then if
okay,
you're at a 200 basis points above that, you're paying 5.7.
okay. Generally speaking, or maybe not today, but back in 2021, 22, floating rates were super, super cheap. And that's what got a lot of people in trouble in 2023 and through 2025 and going into 2026 is those rates were maybe like 2.5 total, and now they were like jumped up to like 6 in this in just a matter of months. So when you go from a 2% interest rate to a 6% interest rate, your debt service pretty much triples, or at least on the interest rate triples. So if you're paying $20,000 a month interest only, guess what? It just jumped up to $60,000 a month. So that can
Big
be hard
hit,
to
big
swallow.
hit. Yeah, yeah. Oh, it can be painful.
So yeah, so like 2020, 2021, SOFR all in looks like it was about 3 or 4. I've seen some that were lower. 22 to 23, they jumped up to 7.5. So triple, at least doubled. So, but one way to mitigate that is people can buy a rate cap. Now, this is not to be confused with a cap rate. A rate cap is a maximum cap that you put on that you won't pay. So if the rates, your all-in rate gets like above 5 and you have a rate cap at 4.5, you're going to be paying 4.5 regardless of if it goes higher or not. But what a rate cap is you have to buy it. It's basically an insurance policy. So the insurance policy, you're saying, all right, I'm going to buy this policy from this company, and if my rate gets above a certain amount, this insurance company is going to pay the difference. So from 2021 to 2023, rate caps, during that whole time when the interest rates were climbing, rate caps were super expensive. You
And
gonna
if you're
say
extending
something?
the rate cap still, there are a few deals that still are. The rate caps are so exorbitant, it's almost not worth it.
Yeah. So then you have to figure out and do the math. You're looking, and I'm saying super expensive, where you are looking at upper 6 figures to 7 figures to buy a rate cap. And
Yeah,
it
there was good.
I was going to say it depends on how long the rate cap is. So when you buy an insurance policy, it's not indefinite. You can buy it for like 2, 3, 5 years. I think 5 is usually the highest I've seen. And then you can buy at different rates, however much higher it's going to be. It could be
I don't
like
remember.
half.
I don't remember the deal itself, but there was one deal that I know they were paying like $30,000 a year for rate caps, and then when interest rates went up, the rate caps would have been $1 million a year.
Yeah. And so it depends on how long it is, and it depends on what the cap is. So if you have a really high cap, your cost is going to be a little bit cheaper than if you have a lower cap. So again, you have to do the money or run the numbers to figure out, does it make sense to put 7 figures into a rate cap for 5 years when we don't even know what the rates are going to be doing for 5 years, or we take that 7 figures and we're going to assume that 7 figures is going to be able to pay the debt service whenever the interest rates climb.
Or you take the 7 figures and buy down some of the debt. So you might have a higher interest rate, but maybe if your debt's lower, then it's not as painful.
Yeah. So there's a lot you can do. How to use that 7 figures the most effectively. So, I was going to say something, but then I forgot what it was.
Want me to juggle while you're doing it?
Yeah. So yeah, rate caps are generally good if you can afford them. And I was going to say, a lot of times if you get a floating rate, the bank is going to make you escrow money every month so that you can pay for the next rate cap. And so if that happens, then that basically is adding to your debt service because you're sending the bank an escrow payment every month. And they could be like escrowing $30K a month so that at the end of the year, there's enough money to buy the next one. Or at the end of 2 years, it's enough money to buy the next one. So, yeah, all depends on your lender. They can require a rate cap. Sometimes they don't. Um, but I know a lot of people who got caught in the 2023 issue where all the interest rates were climbing and they couldn't afford their debt service. And so the bank foreclosed on a ton of properties starting in, was it 2023? Um, so how do you stress test the rate risk? So one, you would do like a base case where you just assume the rates are going to stay as they are. And then you can start stress testing. All right, well, what happens if it's 100 bips higher or 100 basis points, where 100 basis points is essentially 1%. So what happens if you go from like 5 to 6? And then you can stress case again, go in 200 basis points, go from 5 to 7. And then you can start seeing where you start cash flowing neutral, where there's no cash flow, all your NOI is paying for your debt service when you start exceeding it, and at what point do you keep it cash flow positive? So
Stress testing is stressful, so I get
yep.
it.
So as oh so as a passive investor, if you're listening to this and you want to know what kind of debt your sponsors or your investment is going to be using, um, here are some questions that you can ask just so you can stay abreast of everything going on. One, what is the current all-in interest rate? Is it fixed or floating? If it's fixed, is it fixed for 3 years or 5 years or what? Because we had one that was fixed for 3 years and then it changes every 3 years to be prime plus one. So do you underwrite for that? How do you underwrite for that? Are you using it the 10-year treasury, or are you basing it off the SOFR or what? Prime is usually, I think, based off the treasury plus a percentage. I don't remember what it is exactly. And then the bank is adding on their own percentage on top of that. So that would be the prime plus one.
Prime right now is 6.75.
Okay. So prime plus one would be 7.75. If it's floating, so then there's the index and then there's spread. The index would be like the SOFR or the 10-year treasury or whatever. And then the spread would be what the bank charges on top of that. So that would be like the 2.5% over SOFR or whatever. So that's how you at least figure out what your all-in interest rate would be for that month. And then you need to find out if there is a rate cap, if it's floating. And then what's the strike? The strike is where it caps off. So if you are, and I don't know exactly, and I will get all these numbers for the listeners, but the strike, I believe, would be if your strike is like 3, then I'm thinking it would be 3 plus a 2.5 would be your 5.5 would be like your all in. But I've also seen strike as like the cap. So it'd be a strike of like 5.5. So I've seen it different ways, and that's why I don't really know exactly, but maybe there's no universal way of indicating it. But suppose you have a strike of 5.5 and then your interest rate goes up to 6. The rate cap kicks in at 5.5 to 6 and as the insurance policy, and you're only liable up to the 5.5 for the length of the cap rate, so for 5 years or whatever. And so this is also a good point. So if you remember the stress testing that we did, like, I don't know, a couple minutes ago, you can see where you need to buy that strike at so that you don't go into the negative cash flowing part. And then one thing to ask is, how long is the cap rate in effect? Is it for 1 year, 2 years, 5 years? And are you going to buy a new cap rate, or are you planning on selling before the cap rate expires? You and I have both looked at deals that had an assumable loan with a floating rate mortgage and they were still in their cap rate. But if we bought that deal, the cap rate would have expired like 6 months after we bought it. And then we
Yeah.
wouldn't have had that before. So we would have had to raise money for a cap rate if we assumed that loan. So getting out of it, if you get out before the cap rate expires, that's good. If you can make it assumable and push it on to somebody else, that's fine. But then that next person needs to understand what they're getting into. And
We
I
had a
think,
deal where the buyer was thinking about taking over our mortgage. We had just under 2 years left on it. He ended up getting and it was a good rate. It was 4.0 at the time. But he decided to get his own debt financing. So I'm not sure why. And it doesn't matter to me as long as he bought it at a number that works for me. But there's definitely reasons why you would try to take over a loan and why you wouldn't.
yeah, I think that might be in the next episode. But one reason that you wouldn't want to assume a loan is because your LTV is going to be super low typically. Um, if you're assuming a loan, say you bought a property for 5 million and got a loan for 3.5, and say it's interest only, or maybe you've been paying down the principal, so the loan now is less than 3.5, and you want to sell it for 8 million, you just got a LTV of less than 50% because you assumed the loan. So that would be one reason why you wouldn't want to assume a loan if you need more proceeds or whatever. That way you don't have to raise all of it.
We had a similar problem on the deal that we just purchased. Instead of doing one of that, we did a wrap, and then we did a seller finance next to it in order to get the LTV a little higher.
Yeah. And then another question you would want to ask the sponsor team is, what interest rate does the property stop cash flowing? And did you actually do any stress testing? I've known people who say they stress test all the time, but then when you look at their underwriting, you're like, well, where's the stress test? It's like, we did it here. And they show you a graph or a table or something, but they don't really show anything. It's like, did you actually do it? It's like, well, my underwriter said he did it. It's like, well, can I talk to him? And then you never get to talk to him and you never actually get to see the underwriting. And then but that's
Jason, they
another,
stress test 10 basis points.
yeah. So for interest rate and rate caps, that's pretty much it. It's like what's my take on fixed versus floating, and I go back to what my dad told me long time ago, long before 2008, and he's like, never get an ARM, never get an adjustable rate mortgage. And so I have never even looked at a floating rate for anything other than that one that was assumable. What is your take on fixed for floating?
Um, I usually try to lean towards fixed. You considered the 5-year resets to be floating?
No, I consider those fixed.
Okay. Yeah, I mean, if you consider those fixed, then I've never really done much of a floating rate thing myself. 5 years is a fine amount of time to figure out a plan. I have a few partnership deals, JV deals, where 2 or 3 years ahead of time, we know that, well, if we're guessing that the rate is going to go up, so we start paying down that property a little bit more aggressively, not to pay it out, but just to reduce the interest, to reduce the principal, because we know the interest rate is going to go up a little bit to make everything higher.
Yeah. So then this one is like, what's a reasonable rate cap budget for a new deal? So what I do, there are a few rate cap calculators out there. You can punch in however big your deal is or the loan would be. You can punch in whatever your strike would be and how long, and it can give you at least an idea. I will put some of those links in the show notes. I think Chatham has a rate cap calculator, and there are a few others, and I will get those out and put them in the show notes so that you can at least play with the numbers and see what it would take before you actually go buy one. And it's like, when does floating rate debt make sense despite the risk? Honestly, this is running the numbers. This is stress testing with different rates, fixed rates, and everything else. So if it makes sense to do it, and like I tell all my students and I tell all my clients, is everybody has different risk tolerance. I might not want the risk of having a floating rate, but I'm not you. If you think you can mitigate the risks a different way, or you're tolerant of it, you can do whatever you want. Whenever I consult or coach, I just tell people what I'm seeing and things I need to keep in mind. A lot of what we just went through today, and just let them know, hey, this is what happens if if interest rates start climbing, and you need to do this, you need to do that. And so I'm not going to tell you one way or another if it's a good risk or not. So
I would say for me, the shorter the term, the shorter that you plan on holding the property, the more okay I am with floating rate debt. So interest rates don't change that quickly. If you're doing some kind of a 1-year flip, just to get it to be long-term capital gains instead of short-term capital gains, most of the time you can be pretty okay with floating rate debt. Obviously, floating rate does a discount compared to fixed rate debt, especially if interest rates are low. So you're taking a risk there, and like I said, the shorter the term, the better. I'm talking, just over a year, down to less than that. Can I take floating rate debt if it's only a 4-month loan? Yeah.
okay.
Doing a flip, like I said, if you're doing a duplex, if you're doing like a 10 unit that you're just fixing up and reselling it, those are perfect for floating rate debt.
Yeah, and one thing we actually didn't even talk about is the difference. Like a fixed rate right now would be like 7.5, whereas a floating rate would be like 5.5, or whatever it was. So with a fixed rate, you're paying more from the beginning, but you're assuming it'll even out over the course of it or whatever. It's still predictable. But with floating, that's usually more appealing on the front end, and then you have no clue what's going to happen on the back end. So, anything else we need to talk about on interest rates and rate caps?
No, I think in an episode, either the next episode or the one after that, when we start talking about other terms, I mean, interest rates are so important that they should be one thing to talk about. But then it's not just the interest rate that makes up your loan.
Correct. And we're going to deep dive into that next. So
Nice.
If you want to learn more, go to ironcladunderwriting.com. You can look me up. I have a masterclass there. Frank's on LinkedIn, Instagram, Facebook. I'm on LinkedIn, Instagram, Facebook, so YouTube. So if you want to learn more, keep listening and go to my YouTube channel, and we'll catch you next time. Bye. And that's a wrap for this episode of the Ironclad Underwriting Podcast. If you got value from today's conversation, make sure to subscribe, rate, and share the show. And don't forget to connect with us on LinkedIn, YouTube, Facebook, Instagram, or check us out at our website at ironcladunderwriting.com for more insights and updates. If you have a question, a deal you're analyzing, or a topic you want us to tackle, shoot us a message. We'd love to hear from you. Until next time, keep your assumptions grounded, your models sharp, and your underwriting ironclad.